All right, guys. Sorry, there's a new YouTube platform here, so we're getting started a little late. Portfolio Builder members, welcome to our November 13th trade alert. We've got the impeachment inquiry going on right now, which may be causing some chaos in the bond market. And so, can we get an audio check? Can you guys hear me now? Test 1, 2, 3. All right, guys, here we go. Sorry, YouTube changed their platform, so there's a new buttons you got to click. My apologies. Daily income trade alerts at noon Eastern. Current market portfolio allocation is 54% equities, 38% bonds, 8% gold. Our uncorrelated portfolio makes it extremely hard to lose money and allows you to generate safe, consistent income. Our goal is to generate $750 a month per $75,000 invested. Here's our trading schedule. The SPY ETF is traded at noon Eastern, Monday, Wednesday, and Friday, taking advantage of 3 option expirations per week. Emerging markets, we trade on Tuesday at noon Eastern with 200 shares. The TLT is your 20-year Treasury bond. We trade that on Thursday alongside GDX, the gold miner ETF. So the ratio is pretty easy to pick up. For every 100 shares of the SPY, you have 200 emerging markets, 200 TLT, and 200 GDX. Now, if you have a slightly smaller portfolio and you want to take on a little extra risk, play the Tuesday-Thursday combo. You still have stocks and bonds. You do 400 shares of emerging markets and 100 shares of the TLT. And again, our target income is 1% per month or $750 per $75,000 invested. We've delivered slightly over 1% a month on average, but there have been some months slightly lower and some months slightly higher. The good news is we've never had a loss of greater than 1% in a single month. And over a 60-day period, we've never had a losing period. More importantly is our ability to protect your assets during stock market pullbacks. Think about the crash in December. How did you know it was going to magically rebound after crashing 16%? Our portfolio made 1% profit during that period. What about in May when it sold off 8%? We made 2.2%. In August, we pulled a 0.8% return when we had another 6% sell-off. And that's because our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. This allows you to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. So if you click in the description box below, you can sign up for our free educational webinar. That's this Thursday at 2 Eastern. And also, if you'd like a free portfolio consultation, call Dean at 505-322-7515. All right, let's hop into today's trade alert. So the Fed was on TV this morning saying everything is great with the economy and that he hopes the government will stop creating so much debt for them to buy, but they're happy to buy it, was the bottom line. And the Democrats are asking him what he thinks about climate change. Very comical. I haven't listened to too much of the impeachment inquiry, but I do have it paused and plan to tune into it shortly. The results of our previous trade alert from 11/11 through current was that the SPY traded from 307.99 to 308.71 for a profit of 72 cents. We had to give back 27 cents of that profit for our option caller. That's what gives us the safety and protection we need to trade stocks like the SPY when they're at all-time highs and we're on the verge of a trade war with China. The net close profit was 45 cents or a $765 gain. And you can see we've done very well with the SPY in November. And if you go back to the email, you can click on all these links and read each trade alert one by one. But we made $986 on the 8th, $1,734 on the 4th, $1,802 on the 1st. And back on October 28th, you can see where I predicted the SPY would hit 315 at a minimum on a trade deal with China. In terms of our open positions, we kind of have a weird anomaly today. Normally, if the SPY goes up, you'd expect emerging markets to be up alongside it, and it's not. So we do have an unrealized loss on emerging markets, but all we need is one tweet saying, hey, we got the trade deal back in line, and I suspect the emerging markets will travel higher. My target for emerging markets is $52 if we get this phase 1 trade deal. Now, the catch is the trade deal is looking less and less likely by the day, so I'm closely monitoring Chinese media to see if they're still sounding hopeful. I know Trump sounds hopeful, but from his point of view, he's saying that the Chinese are begging him for a deal, and he's not sure if he wants to do it. The Chinese don't seem to be begging him for anything, and the more I gather, they appear to want him to escalate the trade war. Why? It could potentially put the U.S. in a recession, and there's been no U.S. president who was reelected during a recession. So hard to predict what's going to come of that. We'll take a look at the news for any hints. The TLT had a 99th percentile crash last week, so we played it safe and bet down this week on the TLT, even though in the long run, I think the TLT has no choice but to travel considerably higher. And that's not even with the trade war with China. That's just simply from the U.S. government creating too much debt that they can't sell without the Fed supporting the bond market. So how do they support the bond market? Well, they artificially drag yields lower so that bond prices appreciate. And so as long as they can keep this confidence that the TLT will continue to travel higher, investors are going to be super happy buying up long-term debt from the U.S. and holding it because it looks like they're creating appreciation the longer they hold. The second that the yields pop too high up, there's going to be a massive exodus of people who bought these treasuries at too low of a yield who are now realizing losses instead of what they thought they're going to get, appreciation. And so we can see the Fed is doing massive bailouts on the bond market right now and has already cut rates 3 times. So long-term, TLT is a great buy and hold, but we got to realize there's only so far the Fed can go. They're at 1.5 to 1.75 range, and zero's the bottom. Will they go negative? I don't think so. So the time for the TLT is probably another 12 to 24 months before it'll really get to the highest level it can, and everyone realize there's just no more rope for the Fed to keep this act up. Okay, moving along, GDX is up $306. We'll be closing both the GDX and TLT out tomorrow. Here's our breakdown of monthly returns. We're down 0.4% in November, but I do suspect we will have better returns soon as it's more clear what's happening with the U.S.-China trade war. It's been one day it's good, next day it's bad. This makes it very hard to trade these markets. But overall, we've never had more than a single month of loss in July. And if you look at a 60-day period, we've never had a loss, period. So moving along, we can see our total return is at 14.5% in the last 11 months. Now, at this section of your email, I've broken down the profits and the monthly return per asset class. So with the SPY ETF, you can see we've made 1.3 and 1% in November and October. And this is the total return and potential different ETFs we could use in this portfolio. Now, this is not anytime soon, but we have some inverse ETFs and some growth ETFs after we have a market crash and then a reset. So we're nowhere near using that. If I scroll a little bit lower, we have our emerging markets ETF. And once again, when we're at the top of a bubble in the last, maybe the 7th inning, we want to be in the safest, simplified portfolio we can. So that's the emerging market ETF right now. But once again, if we were to get a crash, we have that Yang Inverse EEM ETF we could put some exposure into. And then after a crash and we get a reset, we can actually get better results buying the top companies that are held in emerging markets. Our bond portfolio has generated over half of our profits to date. It's been very profitable despite having some drawdown in October and November. But you can see it has had some very nice returns, including 3.8% in September, 1.7% in May, and 2.2% in December. It's really the secret sauce to how we balance our portfolio and make sure we have very little risk of a large drawdown at any given time. Now, the precious metals portfolio, I do want to note, started off with a smaller allocation in December and has grown throughout the year as the Fed has gone from a quantitative tightening and interest rate hiking phase, which they did for much of 2018, and they've completely pivoted, the Powell pivot, and now he's become extremely dovish. We're doing massive quantitative easing. We've cut rates 3 times. They keep telling us they're not going to do it again, and then they do it again. And so this portfolio has 2 returns to pay attention to. The total profit is 38.96%, and that's based on the total deposits and the total current value. Now, in this, we're just comparing the starting balance and ending balance each month. So do note I wrote that this is the sum of the monthly returns and not the year-to-date return. So those are different figures, and that's because we have been growing this portfolio as the Fed has become more and more accommodative, which is bullish for gold and cryptocurrencies. Moving along, let's look at the current trade alert. We are buying to close the 309 call and then selling to close the 307 put. That gets us out of our previous trade on Monday and sets us up to roll into the next position, which is to sell the 310 call and to buy the 308 put. So what does that mean? We give up all profits after the SPY goes above 310, and if we get bad news in the stock market and the SPY crashes, we'll get at least 308 per share on the put. So this is the protection that allows us to trade the SPY at record highs when we know there's an extreme amount of risk in this U.S.-China Phase 1 trade deal breaking down. So I'm pretty confident come Thursday, without some very bullish news on the trade war front, that'll most likely flip our GDX and TLT positions back to being long and probably just pay a little extra premium for put option protection in case there's any more sell-off. Anytime we see something like the TLT sell-off in the 99th percentile, plan to play it safe for at least a week just to catch any more drawdown in that asset. Our maximum risk reward is $1 in both directions again today. And so this leads us into our news of the day. The order I've put this at today is political news up front, U.S. news second, emerging markets third, and then the charts at the bottom. So this comic has Schiff as the judge, jury, and executioner. Nancy Pelosi. Tune in as members of the House Intelligence Committee hold the first public hearing in our inquiry into the president's betrayal of his oath. In his opening statement, George Kent, a state official whose files include Ukraine, fires a broadside at Rudy Giuliani for undermining the former American ambassador to Ukraine. Without naming him, Kent accuses Giuliani of trying to launch attacks on dedicated public servants. Now, this person who was the former American ambassador was blocking the government officials from Ukraine who wanted to come show evidence of corruption by U.S. And she blocked it. So this has got a lot of legs to it. Also, that Glenn Beck Piece 3 is coming out tonight, so that should be a good watch if you haven't seen the first 2. The Democrats have stacked the deck against President Trump and Republicans. They have leaked out everything. Meanwhile, Hong Kong announces suspension of all schools on Thursday. Nancy Pelosi. Patriotism means putting country ahead of politics and personal ambition and speaking out when you see something wrong. The witnesses coming forward to testify today have shown that patriotism again and again. Breaking. House Intel announces more public hearings. Jennifer Williams, Alexander Vindman, Kurt Volker, Timothy Morrison. Whole bunch. They've got a whole sloosh of public hearings coming at us. So I won't spend too much time on that. We'll get the recap as after each day is finished in our daily update. However, the circus is coming to town. The corrupt, compromised, coward, and congenital liar Adam Schiff shows on Capitol Hill, brought to you by his raging, psychotic Democrats and the top allies in the media mob. Everything you're going to see in the next 2 weeks is rigged. This is a phony show trial. So he's been tweeting about this nonstop, which makes me think perhaps he is motivated to create a trade deal with China right now. Meanwhile, with just weeks to decide, Hillary Clinton claims enormous pressure to run for president. So we got Hillary and Bloomberg coming out in the last minutes. Here's the balance sheet. You can see that sharp reversal from quantitative tightening back to quantitative easing. And we're all wondering if they'll keep this pace or slow it down. JP Morgan saying they need about $500 billion injected into the financial system to get this repo madness problem to come to an end. Meanwhile, $77 billion lent overnight again. So the problem in the money markets are not over, although the Fed says nothing to see here. A little bit of an uptick in inflation in energy, and we do see oil prices a little higher today. Again, inflation is the key thing to worry about for our long bond and stock strategy. While some political chaos or geopolitical chaos, trade war escalations may cause some short-term sell-offs in stocks, the big picture right now is that the Fed is printing money, lowering interest rates, and they'll do that until they either get to the zero bound or until inflation gets too hot. And the second the Fed starts to hike rates and stop printing money, we have to become aware that there's likely a bond crash first and then a stock crash second in that exact circumstances. So a little bit of an uptick, but nothing big. 1.8 is the current print. In terms of Fed funds futures, low probability of any rate cuts coming up on December 11th and 13th, unless, of course, we escalate the trade war. So everybody's got their breath hold to see what happens with that. Powell urges Congress to lower the trajectory of federal government debt, but in case it doesn't, the Fed will gladly expand its not quantitative easing to monetize the debt. Trump advisors exploring income tax proposal to cut middle-class tax rate to 15%. That'd probably give another boost to the old GDP there, while putting more burden on the bond market and the Fed. Kudlow doesn't think the U.S. needs negative rates. No tariff adjustments until China deal has been finalized. Possible rollback on tariffs would be part of a phase one deal. China's saying they won't do a deal unless all tariffs are rolled back. And so I think that would make Trump look pretty bad, but it'd be very bullish for stocks if he did do that. That's why we had that massive sell-off in the bond market, because they know if that much was rolled back, a lot of fear would be pulled out of the market. Meanwhile, some slow signs that China is going to expand its credit impulse once again. They have slowed it down dramatically in the last several months, and it's starting to become questionable if they actually want a recession to try to force Trump out. Here's from the Global Times. A trade deal to end the 17th month trade war will be a plus to China's economy. If not, the country should be steadfast in growing the home market, which is funny. They have 65 billion homes that are not even lived in right now because they've misallocated so much capital. And investing more on infrastructure. Okay, they've got 25 cities the size of China that no one lives in, so I don't know if they need more infrastructure. And doing business and trade with more of the world's other economies. So that means Belt and Road Initiative all over Asia. With China's third quarter GDP growth at 6% versus the U.S.'s 1.9%, China's economy is in better shape. Rising workers' wages, a bunch of baloney here. Their GDP has crashed in the last 5 years from 14 to 6%. So what's more important is the rate of change of GDP. And China's rate of change is extremely negative. That's why we see Germany in a recession and this emerging market phenomena where the Fed can cut rates, print massive money, and the dollar still remains extremely expensive relative to other currencies. And also probably why emerging markets still continues to struggle while U.S. stock market is at all-time highs. Tencent, one of the more important companies in emerging markets, next to Alibaba, has continued to grow alongside Alibaba, who had a record $30 billion day of sales in 24 hours. They call it the Singles Day. Kyle Bass is upset. Trump has ordered Secretary Pompeo and Vice Pence to stay silent on the atrocities in Hong Kong in an attempt to not upset China, preserve the option of a trade deal. Trump is proving that he's like King James and the NBA, willing to compromise human lives for profits. So I think he will get a lot of backlash from the China hawks if he does completely cave in here just to try to get a cakewalk into the next election. Beijing slams U.S. hypocrisy over soaring Hong Kong violence as students launch arrows at police. We had the first death over the weekend, and things continue to escalate in Hong Kong. Why is Taiwan making noises about potential war with China other than the fact that they always make noises? Something is different this time. China's economy has not really grown in half a decade. It makes this a dangerous time for everyone. And that's because China has done all this growth with massive debt accumulation. And now that their growth is slowing down, this is going to cause massive problems for all of its trading partners. Here's a chart of the SPY. And you can see it has been quite a run-up this year. Can it keep going, or are we going to escalate a trade war and get a nice sell-off? That's why we want to be long the TLT. Here's that massive sell-off over the last 2 months in the TLT. This drop right here was in the 99th percentile. We're getting a bounce today, and I'm very tempted to put us back long tomorrow in the TLT with a little bit more premium on our put. So we'll evaluate after the day is closed into tomorrow, but I am looking at that. Same thing happening in GDX. And the sell-off in emerging markets is really alarming because it should be going up with the SPY. Now, sure, it has risen in value 10% since we went long, and it's just having a little bit of a sell-off, but we're seeing Alibaba come out with great numbers, Tencent come out with great numbers. We've got the Fed lowering rates, we've got this phase one trade deal. It really doesn't make sense. It's been selling off for about 2 weeks now, so this is alarming and does bring to question whether a trade deal is really in the works or is everyone preparing for escalation. Meanwhile, in our boot camp program, we're excited to short the Chinese currency as soon as the trade war does break. And so here's your chart of CNH. You can see it's been a very profitable trade if you started at the end of 2017 when this trade war really began. And right now we're just holding our guns on that. If the trade deal is approved, part of it could be rolling back tariffs, which would allow the Chinese to strengthen their currency. Right now they're having to discount all their prices to offset these tariffs, to not hurt their exports. And so too risky to jump into it right now, but we are carefully watching that. Kyle Bass wants to short the Hong Kong dollar, which hasn't moved in probably decades. This is just 5 years of data. It's extremely leveraged. Its housing market is out of control, and its growth relative to China's doesn't match up correctly. That's the basis for why he wants to short the Hong Kong dollar. Money's been flowing out of Hong Kong. There's complete chaos. And the risk of the Hong Kong dollar strengthening is very low. So this is a very attractive trade in terms of very little downside, but tremendous upside. The catch is you're going to get eaten away by the spread on the futures contract, and you need to be extremely patient for this to potentially pay out. Now, Kyle Bass is a billionaire. He's a smart investor. And so I like both of these currency plays, and this will be something we would do in our boot camp. Crude oil picking up a little bit, but not too expensive or cheap for us to worry. Gold had a good sell-off, but starting to tick back up. We're seeing all the big central banks are buying up gold at record pace as they see the inevitable heading, which is a crash in China and massive quantitative easing around the world. The German Bund, the 30-year, has sold off a little bit today, which means that bond prices are going up. That is what pushed the TLT higher. And the big picture is that most likely these rates are going back sub-zero, and the U.S. rates are headed towards zero. So if all of that happens, TLT has much higher to run up for us. Here's the U.S. You can see how correlated it is to the German Bund. And of course, the German Bund is extremely correlated to the health of China. We can't trust the Chinese numbers so much, but we can trust the Germans. So that's why I like to watch that German Bund, even though we don't trade it. And meanwhile, despite all of this, the US dollar is near record strength, which just signals that emerging markets are having a hard time paying off their debts, which are denominated in dollars. To do it, they're printing their own currency, and they are converting it into dollars, which weakens their currency and strengthens ours, which will explain why the emerging markets is slacking a little bit while the SPY is at near record highs. And that's a wrap for today's Trade Alert. Any questions from the crowd before I let you guys go? All right, guys, I really appreciate your time. Sorry for having you sit on there for half an hour while I figured out the new studio features that YouTube put out, but we've got it under control now, so we'll start timely tomorrow right at 10. Today we have our paid member webinar coming up in 5 minutes, so I better hop off and get on there. And tomorrow's our freebie webinar at 2 Eastern. So thank you so much. Actually, our paid webinar is in an hour. Sorry. Okay. See you guys on there.